me here this morning, I'm joined by Capital Network's Ed Stacey. Ed, good morning, nice to see you.
Good morning.
Synnovia full year results out today for the 12 months to March 2019. A reminder for Ed's full report, do click on the eye in the top right hand corner of your screen. Ed, looking at the numbers, what are your initial thoughts?
In line with expectations, so results to March 2019 and crucially the outlook for the year that we've already started. So the revenues were up about 9%, earnings per share up about 2%, and they'd already had a trading statement in April, so we kind of knew those were going to be the numbers. And in terms of that outlook statement, it's a positive outlook statement. They're looking for good progress ahead in the year to come. We are forecasting for this year 10% earnings per share growth. That's a little bit less than what we had in our numbers before, but certainly still looking at a strong year of earnings growth.
Two divisions here, industrials and films. Growth across both?
Yeah, so Synnovia has two divisions and both of them did deliver strong revenue growth. The industrials division, that's things like the ball bearing assemblies for your car steering column and things like that. Strong revenue growth, and that translated into profit growth also. The other division, the films division, similarly you had the strong revenue growth. And remember, it's not obvious that you would get strong revenue growth. When you talk about things like car parts, it wasn't a great year for the industry, but Synnovia really benefiting from the investments that they made the last couple of years, new client wins, etc. That was also the case in the films division, which is things like sacks and pouches for food packaging. Strong revenue growth driven by the investments they've made, but on that side the profit was held back by some sort of start-up costs or early stage costs in some of the new programs there. So that was a headwind on the profit, and that's why the group only had the 2% earnings per share growth.
You talk about the investments they've been making. Of course, that's come through. We've seen that in the revenues here, but the share price of late has been under pressure. What's it going to take to turn that around?
I think that's why we wanted to come in and talk about this today, because as you say, the shares have been under a bit of pressure, and I think the current levels are very attractive entry points. Shares now on just over 8 times PE ratio for the current year. And as you say, you had these investments they've made driving strong revenue growth, and that investment program is ongoing, so that there will still be more to come. And looking forward, I think what we're going to see is start to get some margin improvement, because in the year just gone, you had that revenue growth, you had good steady margins, decent levels of profitability, but it wasn't supposed to be just steady, it was supposed to be improving the margins. I think what you'll get now, we've moved a bit beyond those early phases in some of these newer projects, and you're now at a phase where you really will start to get that margin improvement, and hence earnings growth starts to improve. And then that 8 times PE, I think, is going to start to look very cheap. So that's why it's interesting at this level.
Ed, good to get your analysis. Thanks very much.
Thank you.
And a reminder, Ed's full report, click on the eye in the top right-hand corner of your screen.